All right, guys, welcome to this video where we are going to begin to get into the actual trading strategies that you can implement in your kind of investment system, trading system, and whatnot. And so the first kind of idea that I want to explain, and I will go into another, and I do go into another more detail into in another video titled "Why Assets and Why Financial Assets Move," is that assets, whether it be stocks, crypto, uh, bonds, etc., precious metals, etc., they move due to narratives as much as they do to fundamentals, right? Now, the efficient market hypothesis kind of guys will say, no, like the market is efficient, everything's random. But I'm not going to get into details about how that's kind of, false in this video. That will be covered in the other video that I mentioned earlier regarding, why asset classes move. But in this video, I'm going to specifically get into a strategy called sympathy plays. Sympathy plays. Sympathy. Sympathy. So now, where in previous videos where we discussed kind of money management skills, how much to bet, how much to win, how much to, expect from your expected value formula, that was kind of the poker side of investing and trading, right? Remember when I said that investing equals poker plus chess. So now we are going to get into the chess kind of aspect of investing and trading. And why use the chess analogy, right? It's because in chess, just like in trading, you have to be 1 to 2 steps, a few steps ahead of your opponent, right? In this case, the market. And what constitutes the market, right? It's other kind of people at the end of the day, right? Whether it be people, literally just humans executing trades, or algorithms, which at the end of the day is all developed by humans, right? And so getting to understand the psychology and the kind of rationale of other market participants allows you to be ahead of them and to capitalize on opportunities when they do present themselves, right? But the thing is with investing is you can't be too early, right? Too early is the same as being too wrong. But you always want to, be 1 to 2 steps ahead of people and to think in that type of context, right? In order to basically outperform the market and beat other market participants. Because the financial markets, it's highly competitive. It's not like let's all make money together. Woo, it's like in order for me to win, especially in short-term trading, in order for me to win, I have to take that money from someone else, right? And it's like I said, it's highly competitive. And what is a market? A market is simply a matching of buyers and sellers. Every time I buy, I'm buying from someone who's selling. And every time I sell, I'm selling to someone who's buying, right? And so there's always a counterparty involved in any type of execution of a trade. And so you really have to understand what the other person is thinking, right? And so going back to this concept of a sympathy play, right? This applies to stocks, this applies to crypto. Every time some kind of out of the ordinary event happens, for example, a stock goes up 500%, 1,000% within a few days, right? The people who missed that initial move are always kind of looking for that next thing, that next instance of that event. So I'll give you guys an example. I think it was early 2021, right? GME, GameStop, GME. Jesus Christ, I can't spell. Okay, GameStop went from like a few dollars all the way to up like 20, 35. I don't know the exact number, but it went up like 500% or something plus within a few days, right? The and why did it go up, right? It went up because of a short squeeze. in that short sellers, this is kind of getting a bit too technical, but short sellers who bet for a stock's price to go down were caught, kind of like were trapped in that kind of instance. And buyers came in and they just kept pushing the stock price up, and which led to kind of short sellers getting blown out, right? So GameStop, with kind of its 500+% move, basically established this narrative of the short squeeze, right? And so what happened was people who missed GameStop are looking for the next kind of instance of the short squeeze, right? The short squeeze narrative was in play. And so what happened, right? AMC began to basically go up like a couple 100% in a couple days, right? With AMC, similar kind of narrative, the short squeeze narrative, right? After AMC was like Bed Bath and Beyond, all right, BBBY, and etc. Costs, right? This is another company. So basically, the narrative was all of these companies were highly shorted because investors were betting that these companies would basically go bankrupt, right? So they were shorting the stock, expecting the price to go down. And so what you see with kind of these sympathies is that this initial instance establishes the narrative, right? This would be like the chart of interest, interest graphed against kind of like instances, right? So this is like instance number 1, instance number 2, instance number 3, etc. What you see is that the first kind of instance of this narrative has the highest interest. It establishes the narrative. The second instance, in this case, AMC, people are still, like I said, people who missed GameStop are trying to find the next narrative, the next short squeeze narrative, right? And so AMC goes up, let's say GameStop goes up like 500%, right? AMC goes up like 300%. I don't know the exact number, right? And the narrative dies down over time, but you can still capitalize on it with like the second derivative, third derivative, and I normally don't play the fourth derivative, right? Maybe this one goes up 200%. Maybe this one only goes up like 500 or 50%, right? But the thing is, remember that anytime anything extraordinary comes about in the financial markets, people are all waiting to capitalize on that, right? And the ones that miss the boat are trying to find the next instance of that narrative. In this case, the narrative is short squeeze. Now, it's not necessarily that the percentage gains constantly drop over time. It's just that the interest drops over time until this narrative completely dies down completely, right? And then people, try to find the next narrative, right? It's that, but usually the interest is correlated with, the volatility of the move, because the more people who are interested, the more people are willing to buy, right? The more people who buy, the more a stock or an asset goes up, right? But this could AMC could very well have also gone up like 1,000%, right? This is the actual volatility, or how much the asset goes up in price, is dependent on various factors, including like the outstanding shares, right, and the actual market cap of the company, right? If this company is like small enough, even though this could be like the third tier instance of this narrative, this could still go up like 2,000%, right? If this is a $50 million company, it doesn't take that much money to pump it up. Whereas if GameStop was like a $50 billion company, I don't know the exact number at this point in time, it takes much more money to basically pump up the price, right? So interest is correlated with kind of the percent move, but not a direct cause of it, right? But what's important to understand is that the interest of any narrative dies down over time. So whenever something extraordinary happens, it's okay if you miss the first instance, right? But you always want to be aware of kind of the second tier and the third tier instances that will pop up. After that, as the narrative gets weaker and weaker, weaker, you generally don't want to play that narrative anymore, right? Then you wait for the next narrative to happen, right? Another instance, let's say from the crypto markets, right? Ethereum, uh, let's say. The narrative in this case, this was also in 2021, right? The narrative in this case was smart contract blockchain. I'm not going to go into the technical details of what a smart contract is. It's basically a blockchain network that allows people to program money and applications, right? Think of it as like an app store on the blockchain, right? So Ethereum established this narrative. How did it establish this narrative? By going from like $90, $80 to like $4,000 plus within the span of like half a year to a year, right? And so naturally, when something extraordinary like this happens, people look for the next instance of that narrative, the smart contract blockchain. So what was the second instance of that narrative? Binance Smart Chain, BNB, right? The interest there, right? What is the number three kind of third tier derivative instance of this narrative? Polygon, Matic, right? Four, I don't know, Avalanche. These are all kind of smart contract blockchains, right? And as you'll see, the interest slowly begins to die down until this narrative is completely dead, and then people, try to move on to the next narrative. But you always want to be aware of it's what I call this bouncing ball analogy, right? Every time something extraordinary happens in this financial markets, you want to try to capitalize on the second and third tier instances of that narrative. Beyond that, you can still play these kind of fourth and fifth tier, but you want to begin to size down your positions, right? Because by this time, the narrative may very well be close to dead, if not dead already, right? Again, BNB. So this is another instance, right? Another example of why interest is correlated to the percent gain, but not necessarily causation. Because BNB, what is 80 to like 4,000x? Let's say this is like a 50x move, right? Because BNB was a smaller asset class, even though the interest was lower, it takes less money to move it, right? So even though this was the second and third tier instance of this narrative, and the interest may have died down, this still went up like 100x, right? 100 plus x, right? Maybe AVAX. I don't know the exact numbers, but interest is correlated with the volatility, upside volatility in the move, but not necessarily causation, right? So in summation, this type of strategy is called the sympathy plays, right? It's not based on any kind of technical chart analysis, but more so understanding that you want to be aware of the fact that asset classes and specific instruments, financial instruments, move just as much on narratives, the story, right, as well as the fundamentals, right? And to always be on the lookout for the sympathy plays, as we call it, following the kind of first tier primary kind of mover that establishes a narrative due to an extraordinary event in the financial markets, right? Regardless of the asset class. So that's it for now, and look forward to speaking in another video.